Hi everyone, I'm very happy to welcome you on our next Brown Bag Meetup series. I'm your host Alik Talipov, and today we have our Brown Bag session with our guest Arpi Hambaryan, who is a tech business analyst at EPAM. And if you're new here, this event is hosted by the blockchain professionals community, and we are kind of think space of blockchain engineers, of everyone who is interested in blockchain as a concept and interested in its early adoption. And we host such events every Tuesday after lunch, after in the afternoon in the Central European time. And we also have many other interesting things like conferences, articles, podcasts, and discussions. And without further ado, I am going to invite our today's guest. Just a second. Please give me a moment. Hi, RP. How are you?
Hi, thanks for joining and your interest in this webinar. We are going to discuss decentralized money market platforms. In particular, we are going to dive into the details of compound protocols calculations, and after which we are going to have a quick look through between differences of AAVE and compound protocol. So what is compound protocol itself? It is a money market platform that enables supplying of crypto assets as collateral in order to borrow the base asset. Its initial deployment is done on Ethereum blockchain, and the base asset is USDC. So users have two options. They can either supply assets and wait for some period, then withdraw their initial amount with earned interest, or they can put supplied assets as a collateral and borrow base assets. How the borrowing process is going. So let's say we want to borrow USDC. We can supply BTC and ETH. Collaterals can be aggregated and total borrowing capacity will be calculated based on aggregated collaterals and their collateral factors. The first step would be converting each collateral by their equivalent current price in USD and then multiplying them by collateral factor. Each crypto asset has its own collateral factor, which can be seen in protocols and in functions. So the borrowing capacity will be first calculating the borrowing capacity for BTC, then calculating borrowing capacity for ETH, and then summing up. In this example, our borrowing capacity will be approximately 33,000. After borrowing USDC, users should pay interest. Or if they supply assets, they will earn interest, and both supply and borrow interest rates are variable and are a function of utilization rate of base asset. Each model includes a utilization rate and its corresponding king parameter, which is threshold rate for utilization. Utilization itself is calculated based on total borrows amount divided by total supply amount of the asset. So for calculations, our interest rate, we should follow the following logic. If the utilization is less than king parameter, the threshold for utilization, our interest rate will include base rate plus rate 1 times utilization percentage. If with the utilization increases and is above king parameter, our interest rate will have the following formula: base rate plus rate 1 times king, and then plus additional rate 2 amount multiplied by the difference of utilization and king. So in our example, let's assume we have king at 80%, base rate at 2, rate 1 at 6, and rate 2 at 20%. Usually rate 2 is significantly higher than rate 1. So if utilization is 70%, it is lower than the king, so only base rate and rate 1 will be applied. When our utilization is rising up to the 90%, then additional 20% will be applied. And according to our calculations, it will be like around 8.8% instead of 6.2%. So this is for regulating the supply and borrow amounts and the thresholds of borrowing assets. The next part of money market platforms and next feature is liquidation. Liquidations are acting as a safety buffer and increase in general liquidity of the pools because they incentivize liquidators by allowing them to buy their underlying collaterals with the discounted prices. So liquidation is determined by liquidation collateral factor, which is higher than collateral factor for the borrowing. Let's assume that our liquidation factor is 80%. And we currently have a borrow position equivalent to 1,000 and corresponding collateral current value is 2,000 USD. We have supplied ETH and its current equivalent value is 2,000. Then due to market changes, we have 1,500. So we have a decrease in the price of the collateral, which would mean that this threshold is below the liquidation factor because like 80% will correspond to 1,600. So in this case, liquidation event can be triggered by the liquidators. So what liquidator bot will do, it will close the open borrow position of 1,000 USDC and then we'll get our collateral. But to have an incentive to trigger this action, they are going to have a additional 7% discount price. For us, it will be liquidity penalty. So in the end, they will pay back USDC and then they will get $1,070 equivalent amount of ETH. Then liquidations will exchange this price and then get USDT, or they will whether keep it, but usually liquidation bots automatically directly exchange ETH to USDT or USDC. So the generated 70 profit will be their incentive. And here we are not taking into account the transaction costs. Usually liquidation bots, when deciding whether there is a trigger or not, are included also transaction costs, because for them wouldn't be make sense to trigger any event and then lose money on the transaction costs. So how the prices are updated? Compound uses Chainlink to update market prices, and Chainlink itself aggregates from different decentralized and centralized exchanges the prices for the assets, and then provides weighted, volume-weighted average prices to Compound. So it assures that we are controlling somehow volatilities, and it updated very frequently, so we are in line with the markets. So these are the main features and the main details for the Compound protocol, and in general, these are the base features for any market platforms, money market platforms. So we can say that this is the base for any kind of money market platform, and different money market platforms have additional features or different parameters. So let's say another leading protocol is AAVE. And these are some differences that AAVE protocol and Compound protocol has. So in general, AAVE protocol offers more cryptocurrencies that can be supplied as a collateral. It also offers not only variable rate, but it also offers a stable interest rate option. It has also a feature of flash loans, which Compound doesn't have. But however, AAVE protocol has much more higher fees than Compound protocol. So we would say that depending on the interest of the user, Compound protocol or AAVE protocol may be preferable. In general, as we are having mass adoption of decentralized money market platforms, there are some protocols that also started to offer collaterals and borrowing features, not only based on over-collateralization, but also adding credit rating features automatically calculated by smart contracts. So we can say that in general, decentralized money market platforms is a good tool and provides us the opportunity to borrow and lend assets without any intermediaries. However, we need to consider the risks such as volatility factors of the price fluctuations and liquidity issues, as well as, of course, when we are choosing corresponding protocols, we would need to see smart contracts audits and their safety. So that would be it for this seminar. And any questions, don't hesitate to contact and we can provide any details needed. Thank you.